Jeff Yu, you say they're wrong. All the people doubting Plaza Accord and dollar intervention are wrong. You mentioned the giant Frankel of Harvard, and you say we need to start to think about a Plaza Accord of 2023. Why is the dollar too strong?
Well, the dollar's too strong in terms of valuations, but the US needs to figure this out on its own accord. The dollar itself from the Fed is not really going to matter in terms of financial conditions. You look at the four pillars of financial conditions: rates, exchange rates, spreads, equity markets. FX by a long way ranks last. And also, what does Japan need? What does Europe need? Europe, finally, they're changing their tone. They need a stronger euro to bring down inflation, but they need to realize this actually strengthens consumer sentiment as well and their purchasing power. So this is a very different environment compared to several decades ago. We need to think about not a new Plaza or Louvre or anything like that, but what each country needs for themselves. So that's the difference between now and 3 decades ago.
Let's find common ground between David Folkets-Landau over at a small German bank and Ian Bremmer out with his new book, The Power Crisis, and Every Nation for Itself. Jeff Yu, how do you have coordination if you're not camped out in the lobby of the Plaza in New York?
Well, right now you have enough communication between the central bankers, and we've had that over the last 15 years or so, like the swap lines during the crisis, during the pandemic. But it's kind of backward looking. There's coordination when it comes to firefighting, responding to crises. Look at how the sanctions were brought in after the war started. But where is the coordination up ahead in an era of deglobalization? That's the philosophical question we need to ask. If you're talking about deglobalization, then why bother coordinate? Isn't deglobalization by definition every central bank for itself? So philosophically, where do they stand right now? Where do governments stand? There needs to be harmonization. If not, then we can forget about picking up the phone.
Okay, so Geoffrey, if we don't get that harmonization and we stay where we are, which is in maybe perhaps not a deglobalization, but a regionalization of partnerships, how do you see the euro reacting at a time when people are downgrading some of their growth expectations for world growth? And we're starting to see, I don't know, the euro get a little bit of a bounce from that.
So I think Eurozone policymakers, and to their credit, the ECB is starting to realize this. A strong currency need not be a bad thing. There are more things to an economy than a trade surplus. Let's get away from this 17th, 18th century mercantilist way of thinking. I know it's harder for Asia and Euro to dislodge, but if you have stronger purchasing power, that could actually help offset some of the inflation losses to real income as well. So they need to stay a stronger euro at this point, and the euro is still going to be undervalued, like even 5 big figures from here, right? So that is good for the Eurozone households. It can lift their demand. In real terms, that's good for the euro. So they need to actually cross that hill. They're not there yet, but finally they are starting to shift. So I think the euro will find a new range, a higher range, but still, even with a higher range right now, it's still going to be very, very much undervalued.
We're talking about fluctuations that are minuscule, at least for this week. But the big elephant in the room at Davos has really been China, Geoffrey, and how we deal with the fact that the slowdown that we're seeing from shutdowns probably are not going to end anytime soon. How do you map that out into a currency call, into a growth call, at a time when it seems as though that is going to remain the policy, at least for the remainder of the year?
Well, what's fascinating is if we look at our iFlow custody data, our clients are starting to buy CNY, they're starting to buy Chinese equities, and after an unbroken run of, let's say, 3 or 4 quarters of selling, gentle buying in Chinese government bonds as well. So it looks like the global markets, they're so underweight China right now, they're not actually taking a growth view. I highly doubt that because of the lockdown still happening. But maybe they're just starting to find some value on a total return basis with Chinese equities, Chinese bonds, and also the currency, where it is. But to translate that from a re-rating, from a growth view, I want to go overweight China again. The window is narrowing, I'm afraid. So we need more stimulus, more government-driven stimulus and demand lift right now. But yesterday's Premier Lee's comments, he said basically, to local governments, you need to fend for yourselves, right now. There are very limited resources. That's tough.
Dr. Yu, let's turn to your virology expertise, which is if China ends on lockdown, what happens to the greater Pacific Rim? One day it's going to be over, then what?
Right, then we are going to have not only in an Asian, but probably a global context, the mother of all services stimuluses. And we're talking about not just lockdowns ending, but also borders reopening in China. There's no time frame for that. But look at how Thailand, Indonesia, Malaysia, the ASEAN countries dependent are on Chinese tourists. Davos, Tom, go to the watch shops in Davos, are they complaining about lack of Chinese tourists, buying all those Patek Philippe's, right? So when they return, that $200 billion services deficit China runs with the rest of the world, that is going to be such a big stimulus, something we can all look forward to. But right now, again, no timeline.
Do you think, Jeff, that we're seeing right now people bake in an appropriate slowdown when we take a look at the global economy, or do you think that there's more to come to be priced into risk assets and, frankly, even to yields?
So on a qualitative basis, I think we need to differentiate what is a slowdown versus, basically soft versus hard landing. I think people are still baking in a soft landing right now, but if the Fed turns restrictive and we still think the market's actually not appreciating the risk of that enough, we're talking Fed funds rate going to 3.5 to 4, that kind of level, then a hard landing, that I think the market is probably taking a bit too lightly right now. So we're not saying it's over yet by any stretch. The markets are appreciating a growth slowdown. They're just not ready to bake in a harder landing. So I think that's where some further repricing is needed. But in the short term, valuations adjustments, weighting readjustments, we're seeing a bit of a risk bounce. But I think the Fed will have the final word on that.